Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Lauren, we had a great segment last time, which I encourage you all to look at if you haven't seen it yet, about annuities and how they're being sold.
Yes.
I thought this is a good segue into the tax impact of investments, because not just annuities, but right now we're in the middle of tax season. We're doing, people are starting to get ready, if they haven't already, their paperwork ready to file their taxes. And I thought, to make this simple, I wanted to talk about three different numbers: 0%, 15%, or 35%. Because I'm not going to use I'm not going to use a chalkboard. So three numbers: 0, 15, or 35. Okay.
Right. Yes.
So let's talk about different types of investments. And you mentioned something interesting about your community college class.
Oh yeah, and in my community college class, I'm constantly getting requests from people for investment strategies that will avoid taxes.
Okay.
And I have to tell them that, almost all the time, you don't really avoid taxes. Generally what you do is you defer taxes, which, can be very beneficial. Except that sometimes strategies to defer taxes can actually increase the tax rates that you would pay.
Right.
And sometimes they decrease them. Strategies to avoid paying taxes, though, quite often cause you just as much trouble, or perhaps a lot more trouble, than if you had just paid the taxes in the first place.
Right. Well, speaking of that, like certain things like limited partnerships, things like that, where the whole thing is sold as, well, we're going to defer your taxes or you're going to avoid taxes.
Right.
Well, generally what I have found is if they can, like you said, change the tax law, in a whim in a given year, that'll often deplete the value of the investments, where you actually lose money on the investment. Right. So there's my zero. That's where the zero tax rate comes in. If you lose money on your investment, that's a zero. You don't have to worry about taxes on that.
And frankly, a lot of investments that are sold where the sole reason why you would want to buy this is just to avoid taxes. Yeah, you'll probably end up not paying any taxes on those because you're not going to make any money.
Right.
So there won't be any taxes to pay.
So then the next investment I wanted just to focus on with those three numbers are, we talked about annuities last episode, variable annuities and fixed annuities. Annuities are often being sold as tax deferral vehicles, and they are, because you put money into the investment and you can avoid paying the taxes until you actually take the money back out.
Yes, exactly.
The thing I don't like about annuities is that they use an accounting term called first in, first out, which means that the first dollar you take back out of the annuity is always going to be addressed as interest and not principal, or growth. And so let's say hypothetically you invested something, you stuck it away for 20 years. Until you get all the income out, that's going to come out first before you get any principal out. So where the number comes in is that all payments of growth from a variable or a fixed annuity is deemed to be ordinary income. And so that's where that 35 number comes from. You're never going to get capital gain treatment. It's always going to be the highest tax rate, up to the highest tax rate, depending on what your bracket is, as much as 35% under current law. So there's the 35 number.
Yeah.
Same thing with CD interest, things like that. That's also ordinary income, which would be up to the 35% rate. Now let's talk about mutual funds. Mutual funds is a big thing. Mutual funds can encompass active funds and index funds. Okay. What's your experience with actively managed mutual funds with things like turnover and things like that?
Yeah, if an actively managed fund has high turnover, then well, first of all, they'll be paying taxes inside the fund, which you may never see or never see any accounting of.
Right.
They'll just lower the returns of the fund, and you don't know why.
Yeah, and actually, on top of that, what I've seen in real life practice is when you have an actively managed fund, typically a lot of the investment income that comes out is called short-term gains, which is ordinary income, up to 35%.
Right, exactly. Which is exactly the tax rate you do not want to pay.
Right. And then, so the active manager does a turnover, and that causes short-term gains. Also, investor behavior and how they invest. If they're actively buying and selling funds, and they're making money, if they're making money, that could be up to that 35% rate. Now, my favorite investment topic, and we'll end up on this one, is the way we like to invest, and we think is the appropriate way to invest, is using an index passive strategy. What does that usually mean in real life for investors?
Well, in real life, especially if we're talking about stock funds, if you are investing in indexes, it means the highest tax rate you're going to pay is that 15%.
Right.
And you may not even pay the 15%. You may pay a lot less than 15%, because the worst thing you're going to pay is capital gains. And if you're smart about it, you should really only ever be paying long-term capital gains.
Right.
And on top of that, there are often ways to offset long-term capital gains with okay, for instance, when I sold an international fund, I had bought it at, I think, $10,000, and it was in a taxable account. I sold it, I forget now, but it was around $30,000. I actually had a loss on it.
How?
Well, it was interesting because it was all long term, but you know, the fund had gone up and down over the years.
Right.
And since it had gone up and down, every time I was buying in, or every time because of that volatility, there were losses mixed up with
Right.
the gains. And it was a foreign fund, so you get a foreign tax credit.
And I see the ultimate with the passive index strategy. I had a client that was their only sole source of income was long-term capital gain,
Right.
from because they had to take money out eventually to fund their living.
Right.
The beauty of it was, under the current tax laws, even though that's all they had was long-term capital gains, they had zero tax.
Yes,
which was a beautiful
exactly.
thing. So to summarize this,
and zero tax even though they made money.
Exactly, zero tax and they made money. So, so we're talking about the tax impact of investing. Just as a general summary here, never invest purely for tax motive.
Yes.
Which would be like sometimes a limited partnership, some of
Right.
these other creative things. And then number two, be really wary of the benefit of ordinary income type assets, because if you're getting the same return in a variable annuity or an actively managed mutual fund versus a passive index fund, you're probably going to be paying more taxes.
Yes.
So
exactly.
thank you very much for watching this episode of Erickson TV, and we'll see you next time.
See you next time.
Thank you.